So, welcome everyone to today's class on in the introduction to banking. Last week we stopped after having talked a lot about the general definitions of what a bank is, what a bank does, which functions a bank fulfills, and we now still need to talk a little bit about investment banking versus commercial banking. And deposit taking, on the other hand. Last week I told you that a very general distinction between investment banking and commercial banking can be that investment banking is usually and almost exclusively about wholesale banking. It's about doing banking and offering banking services to wholesale customers, meaning institutional investors and large companies. And in many cases, in many banking groups, investment banking is defined by being, or by the fact that these services are related to capital markets. For example, in Deutsche Bank, you will not find a section or a group that is labeled we are Deutsche Bank's investment banking section, but usually these parts of large banks that are about investment banking will be labeled capital markets. It's the capital markets function of these large banks. Some banks, on the other hand, are purely investment banks, and then obviously they don't have retail banking, they don't have commercial banking. So let's talk about this general distinction between commercial banks and investment banks. Commercial banking usually includes deposit taking and general lending, meaning it could be retail lending, so lending, giving out loans to you as retail customers, households, but it also includes giving out loans to large wholesale customers, like, for example, large listed corporations. Also, money transfer, payment services is also included in commercial banking. And this is what most banks do and how they started out. If you, for example, take Germany, we'll talk about the three different pillars of the German banking system in just a bit. But most German banks are just pure commercial banks. They do take deposits, they give out loans, and that's their core business. Investment banking, on the other hand, includes everything that is related to securities or more generally to capital markets. So, buying, selling securities, advising customers on how to issue securities, stocks, bonds, etc. Anything else related to trading, then everything that is related to advising customers on how to finance deals and how to finance large business transactions. So it includes mergers and acquisitions, it includes finance and corporate finance advisory, and anything that is related to trading. So that's commercial banks in contrast to investment banking. An investment bank is thus a financial institution, might also be a very small one, that helps customers with wealth management, raising capital, raising debt, for example, by advising on how to issue a bond security, and trading securities. So most of the time, for example, you see a Hollywood movie on banks, you rather see investment banks or even brokers and dealers, because most of the time investment banking is the shiny, attractive part of banks you see in a Hollywood movie, right? In contrast to commercial banks, investment banks do not take deposits. And this is not just a question of definition, but this is very important. We'll later on see that in some countries, and it used to be like this in the United States, you have a strict border between investment banking and commercial banking. And in some countries, you are not allowed to do both investment banking and commercial banking. In these countries, you have to decide whether you want to be a commercial bank and give out loans and take deposits, or whether you only want to be an investment bank. In Germany, we do not have this. In Germany, we have what we call a universal banking system, meaning that any bank, if it chooses to do so, it can operate both and engage both in investment banking and commercial banking. I'll give you some reasons why this might be tricky later on. So some countries, in some countries you can do both, in some countries you can only do one of these two. What does an investment bank do? Usually you can broadly distinguish the buy and the sell side of an investment bank. The buy side includes activities like advising companies regarding future investments. So if they don't know how to invest, the investment bank will advise customers on how to invest, which securities to buy, etc. Securitization, sales of engineered financial products to the investment bank clients. Usually these are insurers, asset managers, and so on. And in contrast to the buy side, the sell side, it's securities trading, market making, underwriting, marketing, advising during an IPO, more generally in mergers and acquisitions, and they also do research. What does research include? What does it entail? Any idea? These are usually the well-known analysts. Those are investment bank analysts who will give out research reports and analyst forecasts and will tell you, we view the stock of Apple as a strong buy, or we forecast a stock price for Facebook at $250. I don't know. So this is research, and usually this is an add-on. It's not the largest part of an investment bank, and sometimes they only do it for cross-selling, but this includes investment bank analysts who analyze stocks and investment opportunities. That's one part. Okay. Again, under German law, we have a universal banking system, meaning that any bank can offer both investment bank services as well as commercial bank services. Does it mean that every bank is a universal bank? No. Most banks concentrate on what they do best. And if you've been to Germany for some time now, I would guess that even the exchange students should know that we do have a large sector of government-owned and municipal state banks, Sparkassen. Those are savings and loan associations, usually owned by the municipality. In this case, for example, here, the city of Leipzig. They usually only offer commercial banking services to retail and business customers. They don't offer investment bank services. They might offer these, but actually then they are not offered by the Sparkasse itself, by the Savings and Loan Association, but they're only brought in by a large head institute for all the savings and loan associations in all of Germany. Deutsche Bank is a universal bank. They have commercial banking and investment banking. Some other smaller banks only do investment banking or they only do commercial banking, but it's through their own choice. Legally, they are allowed to offer both. Yeah? Okay. Some countries, on the other hand, at least used to have what we call a separate banking system, in German Universalbankensystem oder Trennbankensystem. A separate banking system is the following. In this system, you have to choose investment bank or commercial bank. Any idea why some countries mandate that you only operate as one and not both? It's simply a question of financial stability. There are very good reasons in favor of splitting up investment banks from commercial banks. Why? Investment banking has usually a much larger risk-return profile. More risk, but also more probability of higher returns. Because you engage in securities trading, you engage in M&A advising, and investment banking is almost always related to much higher risk, but it also offers a higher chance of a higher return, or a chance of a higher return. But if investment banking is of much higher risk and is related to higher risk taking, there are some pretty good arguments in favor of keeping investment banking separate from retail banking and deposit taking, because deposit taking is more or less about safety. It's about protecting the deposits of customers and making sure that the bank is always able to repay customer deposits. And you don't want investment banking being cross-subsidized and being financed with customer deposits, because if it's done in one bank, it's all coming out of one balance sheet. So you want to keep deposit taking and lending apart from commercial banking, from investment banking, sorry. Another reason, first, customer protection and safety of deposits. Second argument in favor of a separate banking system is that there are bound to be conflicts of interest within one bank if it operates as a universal bank. Can you give me a very simple example of a conflict of interest that will arise if you offer both investment banking and commercial banking services? Give me a practical example. You do commercial banking, you give out a loan, a large loan to, say, Google, and you have research analysts who have to value and to make a forecast on the stock price of Google. Now, if you don't keep commercial banking and investment banking completely separate, usually using what we call a Chinese wall within the company, so people are not allowed to talk to colleagues on these matters, what will happen? If you know that your own bank has given out a loan to Google, you might convince your own analysts to say, well, put out a research report that says that Google is a strong buy, to make sure that Google does not go bankrupt, because otherwise you would have a default on your loan. So you will force your own research analysts to put out a false report on this company, and that would be investor fraud. So you have to make sure that in some cases you install what we call Chinese walls, so that these sectors and these parts of your bank are kept separate. If you ever talk to an investment banker who is in trading, they are not allowed, usually not allowed to talk, to make private phone calls during the day, and all phone calls on the trading floor are taped and are recorded for example, the Securities Exchange Commission, or in Germany it's BaFin, for regulators and supervisors to make sure that that there is no chance of investor fraud or insider trading. So supervision is much, much tougher in investment banking because it is much riskier. So that's the separate banking system. It's quite interesting to see how this has evolved in the United States. As a consequence of the Great Depression and the banking crisis in the 1930s, the US installed the so-called Glass-Steagall Act. In the United States, usually, is anyone from the United States? Anyone? Maybe Canada? Ah, okay. In the United States, you might know this, that laws, if they are enacted by Congress, they enter the US Code. The US Code is a huge summary of all the laws enacted by Congress at the federal level. Problem is that, for example, any new law will be inserted in the US Code, and no one knows what US Code 3256 is. So these laws are usually referred to by the names of the people, of the Congress members who brought it to the floor. So in this case, Glass-Steagall were members of Congress. Glass-Steagall Act enacted and mandated that investment banking has to be separate from commercial banking. And this led to a banking system where you had investment banking only banks like Goldman Sachs, and you had commercial banks. In the 1990s, under the Clinton administration, we had a law that is now referred to as Gramm-Leach-Bliley, three people, GLBA, the Gramm-Leach-Bliley Act in the 90s, and it deregulated the banking sector. it repealed many clauses from the Glass-Steagall Act, and the result was that after that, average banking size developed like this, and this is when Gramm-Leach-Bliley came into law. Because banks then started to merge and to merge and to merge, and every commercial bank bought an investment bank, and every investment bank tried to merge with a commercial bank. And this is when large banking groups and bank holding companies that we see today, Bank of America, Citigroup, and Goldman Sachs, these banks started to become so large. Again, as a result of that, because we now had investment banking and commercial banking in one bank and under one holding company structure, people again argued that this led in part to the financial crisis, because we had banks who did both commercial banking and investment banking. As a result, and as a reaction to the financial crisis, we had the Dodd-Frank Act, the DFA. The Dodd-Frank Act, again, brought back some limitations on the extent to which commercial banks could do investment banking. And it forced banks to refrain from proprietary trading, very risky part of investment banking. And now Trump is talking about, again, taking back some parts of the Dodd-Frank Act because he wants to do banks a favor. If you are interested in US politics, you will see one phrase come up all the time, especially from Bernie Sanders: bring back Glass-Steagall. He will call for a renewal of the Glass-Steagall Act from the 30s, forcing banks to choose either commercial banking or investment banking. This is in part due to the bad experience the US have had in the Great Depression, in the financial crisis, and now again. Yeah, universal banking system consists of both. Separate banking, you have to choose. In Germany, and especially in German, in the language, you will sometimes see in newspapers things like Vollbank, Lizenz, etc. This simply means that a full banking license, there is no such thing as a full banking license. It only means that you are a deposit-taking institution, Einlagenkreditinstitut. We've seen that under German law, we have different types of credit institutions. And the one type of credit institution under which you can operate any business is a deposit-taking institution, Einlagenkreditinstitut. This is what is referred to in newspapers and in the media usually as a full banking license. It only means that you are allowed to take customer deposits. And if you are allowed to do so, if you're a deposit-taking institution, then you're allowed to do anything. We don't care about different parts of investment banking, commercial banking. We have a universal banking system. Okay, so that's commercial banking versus investment banking. Let's talk about the German banking system. To put it very simply, we have three types of banks in Germany. We have state-owned, government-owned, municipal savings and loan associations, the famous Sparkassen. We have credit banks, or rather credit unions, mutual banks. Mutual banks are those banks that are owned by customers. And we have private credit banks, private Geschäftsbanken, private Kreditbanken. Very few, and usually these are very large. So in the first pillar, we call them three pillars of the German banking system. The first pillar is, we want to name them. First one is private credit banks, private commercial banks. These includes Deutsche Bank, Commerzbank, and some others. Postbank is also one of them. Savings and loan associations, Sparkassen, and cooperative banks, credit unions, mutual banks. If you walk around here Leipzig, you will see all three. You will see Sparkasse Leipzig, you will see Volksbank, People's Bank, which is usually the name we give to credit unions, and Deutsche Bank, Commerzbank, etc. All three pillars have some special characteristics and peculiarities. For Sparkassen, for the Savings and Loan Association, most importantly, they are state-owned and government-owned. They are owned by the municipalities, in this case, for example, the city of Leipzig. They don't compete with each other, so you will not see any other type of savings and loan association in Leipzig, only this one, City of Leipzig, Sparkasse. Same goes with credit unions. You sometimes see maybe two different types of credit unions, but usually it's just one per city. They don't compete with each other, and they only accept customers from that municipality, from that region. And then you have private banks who will do anything. They will enter a market, they will not open a branch somewhere, they will compete with each other, and it's a free market here. Now all compete with each other. And we have no regulation in place on, say, market shares or competition. Each and every one can compete with each other, and in part this is also due to the liberalization of the European banking sector. We used to have some special rules for savings and loan associations, but the European Commission rightfully argued that savings and loan associations have to compete in this free market and they should not get preferential treatment. All these banks are regulated and supervised by Deutsche Bundesbank as Germany's central bank, by BaFin, the Federal Financial Supervisory Authority in Bonn and Frankfurt, and the European Central Bank. And they work together in banking supervision. We'll talk about this later on, but to put it very simply, European Central Bank is responsible for the large, systemically important banks. The, let's call it, day-to-day supervision is done by Bundesbank, and BaFin only steps in for laying out general rules and if something's off. So in case there is something wrong in a bank, BaFin will team up with Bundesbank, but usually Bundesbank is responsible for the day-to-day and ongoing supervision of banks. It looks a little bit different with insurance companies and the securities exchanges, but in banking, ECB, systemically important ones, Bundesbank does the day-to-day ongoing supervision, and BaFin sets the rules for supervision in cooperation with Bundesbank, and only steps in case, for example, for bank resolution and these things. Again, please note, Germany is a universal banking system. Even though some banks refrain from engaging in investment banking, they are allowed to do so. They could if they wanted to. And then it's rather for historical rather than legal reasons. This is a German slide. You have universal banks which do everything. Credit banks, private credit unions, and savings and loan associations. And you also have special institutions, banks that only engage in some selected markets or offer only selected businesses and services. For example, you have online banks, very simple. You have some credit institutions with special tasks. That's weird. That's very peculiar to Germany. Actually, one of the largest banks in Germany is KfW, the Kreditanstalt für Wiederaufbau, the credit institution for reconstruction. It was installed after World War II to finance reconstruction of Germany after the Second World War. Well, we've achieved that, and they've gone on to being more or less the private bank that engages in the private banking sector for the federal government. And it supports special projects by the federal government and gives out cheap loans, sometimes very cheap loans or loans at 0% interest, and that supports some policy projects from the federal government. For example, if you are a house owner, if you are a homeowner, and you're thinking about renovating your external walls and to provide it with, how do you say that in English? Wärmedämmung. If you want to make sure that the heat energy doesn't leave your house and doesn't go right through your windows and your walls, you can spend a lot of money on making your house more energy efficient. And for this, if you satisfy certain requirements, you can get a loan from KfW with some subsidies. So subsidies are actually paid out by KfW, Kreditamtsstelle für Wiederaufbau, and these sort of things. Also, we have some real estate credit institutions. These are banks primarily that focus on, I told you this, Pfandbriefe. Those are securitized loans and loans with additional collateral and bonds that are linked to additional collateral. Also, usually not found in most countries. So let's talk about supervision. Again, we have European Central Bank and Deutsche Bundesbank. Just to be sure, Deutsche Bundesbank operates regional offices throughout Germany, and supervision is done by the regional offices. For example, Deutsche Bundesbank has one large office here in Leipzig, and this one is responsible for banking supervision, I think, in Thuringia and Saxony. So it's not just the headquarter in Frankfurt, but these are the regional offices. And we have BaFin, and they supervise everyone. German banks, but also the subsidiaries of foreign banks operating in Germany. Okay, 3 pillars. Private banks, very simple, are just private banks. They can do anything they want. They can do investment banking, they can do commercial banking. They only have profit maximization and maximization of shareholder value as their sole business objective. What else should they have? It's just about maximizing shareholder profit. They trade under the legal form of a stock corporation, or as a corporation, which is KGaA, Kommanditgesellschaft auf Aktien. It's not a corporation, but the shares, well, they are actually in the form of shares. It's one of our legal entities under German private law, but usually these are stock corporations, Aktiengesellschaften. And most of the time they have their focus on securities business and on investment banking. There are only few very large banks that are truly universal banks. Deutsche Bank, Commerzbank, Postbank, those are the main ones. Yeah, Deutsche Bank, Commerzbank, Postbank, also Hypo-Vereinsbank, HVB, HVB, UniCredit. It is included here, but one has to make sure that HVB, Hypo-Vereinsbank, is no longer truly a German bank. It is very large in Germany. It used to be Hypo-Vereinsbank, but it was bought by UniCredit. Where does UniCredit come from? Any idea? Okay, no one's from Italy, it seems. It used to be Unicredito. But to make it easier for people not from Italy to pronounce it, I guess they call them UniCredit. At some point, I guess, they will completely rebrand it. They started out as Hypo-Vereinsbank, a member of the UniCredito group. Then they became HVB, Hypo-Vereinsbank, UniCredit. And they are slowly rebranding it towards UniCredit. But most people in Germany only know Hypo-Vereinsbank. Postbank is fully owned by Deutsche Bank. Was privatized, and now it's part of Deutsche Bank. Deutsche Bank Every now and then they think about, should we sell it? Should we keep it? Should we sell it? Should we keep it? Now it seems they want to keep it because they've realized that they cannot, investment banking is currently not their strongest part. So they're again trying to keep it. Some smaller regionally operating German banks like Nationalbank, Südwestbank, or internet banks, ING DiBa, Comdirect, DKB. Last I heard is that Comdirect is also on the brink of being absorbed again by Commerzbank. Commerzbank has decided they want to close down a lot of their branches. They want to move more into internet, online banking, and now they've realized that they have their online banking division, Comdirect. They sold part of it, and they're still a majority shareholder, I think. And they've now realized that if they want to move Commerzbank into the direction of being an online bank and relying more strongly on online banking, they realized that their own subsidiary, their own division, former division, would be one of their competitors. So they have offered shareholders to a takeover bid for Comdirect. It's quite a tricky move. They're actually offering less than the current stock price. And quite interesting to see where they will go from there. DKB, Deutsche Kreditbank. This is a good example. Some banks have found their niche where to operate and where to survive next to Deutsche Bank, Commerzbank and Postbank. DKB, another bank is Fidor. Anyone ever heard of these banks? They act, I would say, as the banking vehicle for companies that want to offer payment services but who don't want to apply for a banking license. So DKB, for example, well, you're probably not yet their target group. They offer the Visa credit cards. They offer credit card services for Lufthansa Miles and More customers. So if you want to get a credit card from Lufthansa, German's flag carrier, Lufthansa doesn't want to be a bank, but they've teamed up, they have a cooperation with DKB to offer a banking service, a credit card. DKB is also one of the few partners of Apple Pay. Even though Apple has a banking license, they still needed a bank in Germany, and they, for example, also use DKB. Fidor Bank is one of those banks that have now, I guess, a long history of cooperating with fintechs. Fintechs don't want to be registered as a bank most of the time, because if you only have 5 people working for your fintech, you don't want to deal with BaFin. So what they do is they cooperate with few selected banks that have specialized in teaming up with small fintechs. And I know some of them are cooperating with Fidor Bank. And then we have private bankers, banking houses. These trade under the legal form of a general partnership or a limited partnership, Kommanditgesellschaft or offene Handelsgesellschaft. This is a relic from history, because most of the old banks, even going back to the medieval ages, to the Middle Ages, that have still survived to the present day, they weren't formed in the legal entity of a stock corporation. They were formed as limited or general partnerships, and they are still allowed to operate nowadays. But paragraph 32 of the German Banking Act states that these banks can no longer be founded. So you cannot found a new bank that is not a stock corporation, usually. Why? Because German lawmakers think that this is a rather unsafe legal construction for a bank to operate under. However, they didn't want to close down those banks that were here in Germany long before even this state was founded after the Second World War. So some of these companies like Berenberg Bank, Bankhaus Lampe, Sall Oppenheim, these are famous, very old banking houses. We call them banking houses, Bankhaus, German translation. They offer private banking services, and usually private banking means you have to have a wealth of more than 1 million euros to be accepted as a customer. So they will not accept you or me as a customer. Okay. Very famous in Switzerland as well. Foreign banks. Obviously, we have some banks who have come to Germany after the European Union liberalized and deregulated the banking sector. We have some banks. I think the Swedish SEB Bank, I think they have left Germany. We used to have Citibank, Citigroup. Citibank was sold, the German division was sold by Citigroup to Crédit Mutuel. Now it's French, and they rebranded it to Targobank. Targobank, we have Santander. Is anyone from Spain or some? Get used to it that we call them Santander Bank. Even though if my Spanish doesn't fail me, I think it's Santander, right? Yes. It's Banco Santander. But Germans can't speak Spanish most of the time, and they say Santander Bank. Okay. It's the Banco Santander, and its German subsidiary is the Santander Bank in Germany. Santander Bank and Targobank are retail banks only, and very aggressive ones at that. Meaning what? They will try to get your contact details, and they will try to get your address. By, for example, offering 0% loans via electronic shops like Saturn or MediaMarkt. You might know this. This is very famous in Germany. Our large electronics chain stores, they offer 0% loans on large sales. So every now and then you get, even before we had zero interest policy, when interest rate used to be positive, you could get a 0% loan when you bought, for example, a flat screen TV. And the banks that cooperate with these electronics chain stores usually are either Targobank or Santander Bank. And their motivation is quite simple. They want to get your contact details, and after that they will send you letters and mail every week. They will send you a letter. Unfortunately, I get a lot of them privately. They will send you a letter stating, do you want to have a nice vacation again? You can get 10,000 euros instantly, just for 12% interest, and we will not check your credit score. And the only way this works is via retail banking and in wholesale. They will give out a large number of small loans, and they will have automated credit risk scoring and credit risk management, and they do not care if some loans will default. It works in their large portfolio of small loans, and this is their business model. So very aggressive retail banks. And last but not least, we have some banks who do operate offices in Germany, but who are only here for the sake of catering to their customers from foreign countries, like ABN AMRO. It's a Dutch bank, and I don't think they offer customers here. Some private mortgage banks, Hypo Real Estate, private building societies. Private building societies, does anyone know the German name for that? Well, it says there, Bausparkasse. Building societies, Bausparkassen, they are different. They are actually closer to an insurance company. Building societies work like, can anyone describe how Bausparkassen or building societies work? How does their business model work? I start out as a first customer, I want to build a house. So I now start to save money and I pay money into my account. Say, for example, 1,000 euros every month. I will save money and all the interest will go to my account. And after, say, 15 years, I want my money back. It will be paid out to me. And I want to get the rest of the money I need, the rest of the capital I need to buy the house as a cheap loan. Again, you can see this dates back to a time when we had normal interest rates, say 5–6%. So the deal would be, I save money, I save, say, 100,000 euros. I need an additional 100,000 to buy a 200,000 euro flat. And if interest rates were at 5%, I would only have to pay like 3% on the 100,000 euro loan. And I start out as a first customer, then a second one joins, and so on. And it is evenly distributed across time, and the loans are financed by the money that is paid into their accounts by other customers. And the building society invests the money and then tries to lower interest rates on the loan and to increase interest rates on the accounts by doing good asset management. As you can see, this is basically life insurance. It's more related to life insurance than it is to banking. Well, they are considered to be building societies and Bausparkassen and banks. So this is, for example, BHW, Bausparkasse, BAW, Bausparkasse, that's a private building society. Now we have some lobby groups. It's the Bundesverband Deutscher Banken. And you will only hear it referred to as the Bundesverband. It's a federal association of German banks. It's a lobby group. And they also organize deposit insurance, deposit protection for private banks through Compensation Fund of German Banks and Deposit Protection Fund of the Association of German Banks. So we have two deposit insurance schemes in place for private banks in Germany. You see some numbers here. It's gradually going down. In 2010, 10 years ago, we had 218 private banks. 4 years before that, we still had 360. Branches go down, number of banks go down, and the market in the sector is consolidating for obvious reasons. This is an extract from the annual report of Deutsche Bank as the largest private commercial and universal bank here in Germany. As you can see, those were better times for Deutsche Bank, because in 2014 they reported a net income of 1.7 billion euros. And it's very interesting to see, we'll talk about this in more detail later on, but the income statement of a bank usually includes large two parts: interest income and non-interest income. This is important for the following reason. If you want to check and easily check whether a bank engages in investment banking, you only have to check the non-interest income. Because most of the things banks do in investment banking will earn non-interest income. Commissions, fees, net gains and net losses on securities trading, these are included in the net non-interest income. If you're interested more in this, there's a working paper that's, I think, now 7 years old by Markus Brunnermeier from, it's Dong Palia Brunnermeier. It's a working paper, still a working paper from Markus Brunnermeier, who is a professor of economics and finance at Princeton University. And what he did after the financial crisis, he wanted to check whether more investment banking is detrimental to financial stability. And what he did is, he calculated for each bank in a sample the ratio of interest to non-interest income. So if you have more interest income, you're more likely to be a commercial bank. If your ratio of non-interest income to interest income is higher and larger, then you're engaging more in investment banking. So this is the income statement, and this is the asset side of the balance sheet. What is very common for banks, it's banks usually have the largest balance sheets you will see around in an economy. Whereas, for example, large industrial companies will have balance sheets and total assets of, say, 20 billion, maybe 50 billion euros. 50 billion would be a huge, large car manufacturer. It would be considered a very, very small bank. In this case, Deutsche Bank 5 years ago had total assets of $1.7 trillion. 1,7 Billionen Euro. Why? Well, what do banks do? They engage in taking in and giving out capital. So if you're in the business of managing capital, it's quite clear that your balance sheet, your total assets will be very high. And here you have 1.7 trillion, and quite interestingly, total financial assets at fair value, the majority of their total assets is held up in securities. Even worse, in accounting, you might know that you have two different sets of accounting rules. You have US GAAP, US Generally Accepted Accounting Principles, and IFRS, International Financial Reporting Standards. Now, Deutsche Bank actually files its statements both under IFRS and US GAAP, and it makes a huge of a difference. Under IFRS, Deutsche Bank has total assets of approximately 2 trillion, or 1.7 5 years ago, 2 trillion. Under US GAAP, only 1 billion. So it's only 50%. So the balance sheet shrinks down to 50% under US GAAP what it is under IFRS. Any idea why that is the case? Under IFRS, you are not allowed to net derivative positions. For example, first of all, let me ask, who does not know what a financial derivative is? Like an option, swap, future contract. Everyone clear about what a derivative is? Okay. Now, derivatives are usually, most of the time, used for hedging purposes. So you have a position, you want to hedge this position, use a financial derivative, and in combination it might be that the combined hedge position has no risk at all. Under US GAAP, you are allowed to net, and you have offsetting effects, meaning that you don't have to include it in your balance sheet because it's fully hedged. Under IFRS wants to give investors a clear picture of what is going on, so you have to include both positions. And this, in the case of Deutsche Bank, forces its total assets, the size of the balance sheet, to go from 1 to 2 trillion. On a side note, it means that most of the balance sheet of Deutsche Bank consists of financial derivatives. If you think financial derivatives are very risky, well, you should know that Deutsche Bank consists of financial derivatives of up to 50%. That's what they have a lot on their asset side here. Liability side, 500 billion euros in deposits and total financial liabilities at fair value, 700 billion. Trading liabilities, financial liabilities designated fair value, investment contract liabilities, and so on. And total equity of 73 billion. Now let's make that calculation. This means that in a very, very simple way of calculating the equity ratio, Deutsche Bank has 4% equity. Also, very common for banks to operate with high leverage, extremely high leverage, and with very low equity ratios. Now, be careful. This is a coarse way of calculating the equity ratio or leverage. I simply took total equity and divided it by total assets. If you ever hear anything about capital ratios in banks, this usually refers to regulatory capital. Because regulators and bank supervisors don't just take total equity, they also take certain other parts of the balance sheet and include it in what is then called regulatory capital. We'll see that in, I would say, 5 to 6 weeks. But at this point, it suffices for you to see 4% equity ratio is not too much. And it's extremely low compared to industrial companies. Industrial companies will sometimes have 30, 40% equity. Not so in the financial sector. Then we have public sector credit institutions, state-owned government banks, government-owned banks, you name them. In Germany, we usually just refer to them as Sparkassen, Savings and Loan Association, and it's implied that it's owned by the state, by a municipality. It could be a city or it could be a county. Sometimes you see Stadtsparkasse, which translates into City Savings and Loan Association. Sometimes you have Kreissparkasse, which is a county bank. When it comes to research, it's important to see that savings and loan associations in Germany have quite frequently been studied by researchers because they are unique in the sense that they are state-owned, they are owned by the local government, but they have to compete in free market. So you can study a lot of those effects state ownership has on companies, but still in a free competitive markets. We know, for example, in socialist, in communist countries, you used to have, or you still have, government-owned, state-owned companies. Well, yes, but this constellation where you have state-owned banks that still have to compete with private banks, that's very unique here. So in research articles, you usually see these banks referred to as state-owned banks or government-owned banks. They are owned by the municipalities. Very few examples exist for banks that are owned by the federal state or the states, like Saxony. And I might have told you that some banks, some savings and loan associations have a very, very weird legal construction. I'll come to those later on. They owe their existence to specific public interests. They don't want to maximize profits. They want to offer banking services to the population. Same with mutual banks. Their prime interest is not in shareholder value. Although politicians will sometimes force banks to also look at profits because they want to take some of the profits and invest the money themselves as a municipality. They often, but not always, have the legal form of a public agency institution. Don't rely on the English translation. It's Anstalt des öffentlichen Rechts. So it's an institution under public law, under public law. That's a correct term. And they usually restrict themselves to certain regions and to some banking services. They will not offer all banking products. Which ones do we have? Deutsche Bundesbank. One usually forgets that this is also a state-owned bank. And from each country to country, it's a different question what legal entity the central bank takes. In the case of Germany, Deutsche Bundesbank is also a state-owned bank owned by the federal government, and profits will go into the federal budget. Also, it's a bank, and you usually don't realize this, but if you know someone who's working for Bundesbank, every employee of Bundesbank has a checkings account with Bundesbank. And it's quite interesting because we mortals, we have a normal bank account, but employees of Bundesbank, they have a bank card and they have credit cards with the federal logo on it. So that looks quite nicely. And their ATM machines dispense minted banknotes before they go into public, into circulation. So they are the first ones to get fresh euro notes from the ATM machine in the cafeteria. That's a bank. DK Bank, Deutsche Girozentrale. This is the head institute of the savings and loan associations. We still have state banks, Landesbanken. They are owned by the states. For example, the state of Hamburg, the state of Bavaria, the state of Lower Saxony. And it used to be that every state had its own state bank. Slightly different names. For example, here in Saxony, we used to have the Sachsenbank. That went bankrupt during the financial crisis, and it was bought by LBBW, Landesbank Baden-Württemberg. LBBW, now it's called LBBW Sachsenbank, State Bank of Baden-Württemberg. Helaba in Hesse. Bayern LB in Bavaria. Nord LB for Lower Saxony. And I think Bremen. Some famous examples vanished during the financial crisis. West LB, the state bank of North Rhine-Westphalia, my home state, went bankrupt during the financial crisis and had to be resolved. Then Sachsenbank and HSH Nordbank, the state bank of Hamburg and Schleswig-Holstein. I think it still exists, but it has cost those two states a lot of money and a lot of headaches. And we have savings banks. We used to have 417, the number is decreasing by the day, and some so-called independent savings banks. Freie Sparkassen. And actually the largest one is a free savings and loan association, the Hamburger Sparkasse, the HASPA. Why is it called an independent or free savings bank? Again, for historical reasons. In fact, this one is not owned by the Free and Hanse city of Hamburg, but it owns itself, more or less. It's owned by a fund that is also regulated by the city, but in a sense, it is owned by it owns itself. It's a completely independent entity, but still, it's a savings and loan association. We have some Grundkreditanstalten, public law real estate credit agencies. We don't bother with that. Banks with special tax, with part concession, KfW banking group, and state-owned regional banking societies. We do have them. We will not talk about them in detail here. In 2006, savings banks in Germany had 14,000 branches. Again, this number is decreasing by the hour, I guess. And total assets of around 1 trillion euro. This is interesting. Especially savings and loan associations are still famous for operating branches everywhere. And not just an ATM machine, but even employing people to sit in a branch where nowadays no customers walk by. They can no longer keep this up, and they are closing down branches by the hour, because branches and personnel costs are costing them the profits in a zero interest environment. And savings and loan associations are notoriously famous for a couple of things. First of all, they enjoyed some very nice protection before the European Commission stepped in. They had what we call Anstaltslast, institutional liability, and guarantor liability, Gewährträgerhaftung, which meant until 2005 that basically they were free of default risk. Because they are state-owned by the municipality, the municipalities, the cities and the counties basically gave them the guarantee that they cannot go bankrupt. Now this means that in a free competitive market, these banks had ideal financing opportunities, because if they needed financing, say from institutional investors, they could always say, we cannot go bankrupt because in any case the city will pay for our debt. So they got perfect financing conditions and very low interest rates on their debt. In that scenario, the European Commission argued, rightfully so, that this is an undue advantage and an impediment to a free competitive banking sector within the European Union. And banking groups from other countries like Spain, France, Italy that want to compete with these banks in Germany would have a bad standing, because these banks obviously get an unfair advantage by the state giving out guarantees to public banks. This ended in 2005, and nowadays they don't have this any longer. So they can go bankrupt, and they merge sometimes. This happened with my Savings and Loan Association also. Now the way it works is that, for example, I don't have it with me, each Savings and Loan Association is independent. It has its own management, its own supervisory board, and say, for example, the City Savings and Loan Bank of Leipzig can do basically whatever it wants. It's a free corporation, it's a free bank. However, all savings and loan associations have agreed to have certain joint standards, and they have joint marketing, they have a joint corporate design, and they cooperate at many different levels. And this has led to a very strange organizational structure where you have at the top the DSGV, the German Association of Savings Banks, Deutscher Sparkassen- und Giroverband. The DSGV is basically the meeting of elected managers from the set of all savings and loan associations. They will jointly elect the leadership of the savings bank sector in Germany. And you have one insurance company, you have one head institute that acts as basically a central bank for the sector, the DK Bank. The Landesbank, the state banks, are also included in this because they are owned by the states and the municipalities are at the same level basically. They have one IT service company for all savings and loan associations. They have one rating and risk management corporation, S-Rating. And so, if you go to a savings and loan association, you will see the same logo, the same marketing. They will give you the same products. If you want to buy an insurance contract, more or less it's just, well, in the savings sector and savings and loan association, they have more than one insurance company, but only one for a region. So you will buy those contracts from one insurance company. You will buy your securities from one investment bank. They only have one asset manager, and all the internal processes, online banking, risk management, these services are bought from service companies within the sector. And this is good and bad at the same time. It's good for us customers because if you have an account with, say, a Sparkasse here in Leipzig, Sparkasse Leipzig, you can withdraw money from any ATM machine that has the red S for savings, Sparkasse, anywhere in Germany. The disadvantage is that this is basically organized, this whole sector is organized like a state. You have the local level, the local banks, you have regional level, some regional representatives, and you have some elected representative at the federal level. And the German Savings and Loan Association sector is notoriously infamous for being extremely slow at introducing, jointly introducing new processes, because if they do something, they have to do it across all savings and loan associations in all of Germany. And this is why it takes a huge amount of time to introduce new products, new processes. They teamed up with credit unions to introduce something like Apple Pay 10 years after Apple Pay, because they needed such a long time to come up with a fancy idea of mobile payment. Yeah? And when they introduced it, even the banks argued that we just want to bury the whole project. It's no longer useful. So this is one problem with German savings and loan associations, and because they are so slow, they are very, it takes them a lot of time to react to new customer wishes, and this is why profits are going down dramatically, and the only thing they can do at the local level is to close down branches and to cut personnel cost. The worst part is that they are also, at least in my view, the smaller ones are also famous for being very conservative and not being, how should I put it? They think they are customer friendly, but in fact they are not. I had this experience a couple of weeks ago. I attended a conference in the US, and I also attended a conference before that in South Korea, and then I went from the US to Canada. The result was my bank, they blocked and invalidated my credit card, because it seems that if you're in the US and then you take a card to Canada, they think the card has been hacked. I had to call them 5 times to ask them to revalidate my credit card and to make it accessible again. And finally, it stopped working at all. I went to my bank branch and I told them, I just want to cancel the whole account. No reaction, really. It seems they didn't really care. They didn't even ask why I was so unhappy with my credit card. I told them I don't have a credit card that I don't want to have a credit card that doesn't work in a foreign country, and don't give me any bullshit that South Korea or US or Canada is somehow a shady country. It's not. It's not a country where you would normally expect hackers to sit, right? Second thing is, I wanted to open an extra account. I was in the bank. I was actually in the branch, in the head branch, and I said I want to open a new account. They had people sitting around, and they said, "Oh, can you give me your card?" I said, "Yes, I'm a customer. Here's my card." "Oh, I see your financial advisor, your customer representative is Mr. Yada Yada." I said, "Well, that might be. I want to open a new account. Then we have to make an appointment with your customer representative." I said, "No, I want to open this account now. But I can access his calendar." I said, "No, I want to do it now. I'm already in your branch." It's the rare time a customer walks into a branch. Every other time I would do it online. The person didn't realize that at that point she had lost me. And I only said to her, "Don't bother, I just go to an internet bank. I don't care. I don't want to come here another time." I think that's very famous for Sparkassen. Yeah? I'm still a loyal customer, but no new business. I don't want to do that. And also a very funny thing, one of my former, they also changed a lot. My former customer representative tried to sell me some securities, and he tried to advise me on my personal finances. And you should have seen his look when I told him, "No, I'm a professor of banking. So if I don't know what I do in my personal finance, I'm probably not good at my job." Yeah. Okay. So that's just on a side note. To be clear, local savings and loan banks do a pretty good job when it comes to supporting local interests, supporting public life, because they are not in for the money. They are not primarily interested in profits. They want to support local businesses. They want to support local retail customers, and they also give out a lot of grants and subsidies. So that's on the plus side. But on the downside, they are sometimes not up to the competition, especially by private banks. Okay. Now I have to ask those two students in the back, if you want to sleep, please leave. I guess they are already sleeping. Yes. If you want to sleep, leave. Yes? Okay. This is an example, Haspa. Again, largest German savings bank, Hamburger Sparkasse. What is so telling from this balance sheet is that public savings banks rely heavily on customer deposits. Usually they have no investment banking, and as you can see from the asset side, it's just about taking in deposits and giving out loans. Very different from Deutsche Bank, and you can see this here. These are actually claims against customers, loans, basically. On the liability side, deposits, 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 liabilities to customers, those are customer deposits. They don't rely on other forms of financing. It's usually just deposits. Okay. Now the third pillar, in contrast to private banks, is credit unions, cooperative banks. In German, we just call them Volksbanken, Spar- und Darlehenskassen, Sparda-Banken, etc. They're different from the other two sectors because they are not state-owned, they are not fully private, but they are organized as mutual companies and credit unions. Laid out in paragraph 1 of the Cooperative Act or Genossenschaftsgesetz. The sole purpose is to establish and to promote business. You see this every time when you have a sector where private companies do not offer the services for some reason that customers are looking for. And this is almost always a sign of market failure, where you have no market that has evolved. You see in agriculture, farmers cooperate to buy resources and to sell their products. And they want to get better prices, so they cooperate and they form a cooperative. The same here. In cities, people needed credit, they needed loans, so business owners and private households, they teamed up and they formed their own bank in times when there were no private banks around. So mutual banks, usually, have the following characteristics. First of all, shareholders are customers and customers are shareholders. If you want to get a loan or if you want to open an account with a credit union, you have to become a shareholder. Now that's not a big problem because shares, for example, in my case, shares will be given out in, I think, with a nominal value of 30 euros or 20 euros. So you will have to invest 20 or 30 euros to become a shareholder, and you cannot buy more shares. Each and everyone has the same share. Only thing that happens is every year the profits will be paid out as dividends, and those dividends will be paid to your share account, to your equity account. So if at any point in time you leave this company, you are no longer a customer, or if you die, you will be paid out your share and all the accumulated dividends. And that's a credit union. Usually they only do regional business. They primarily grant loans. So with the savings and loan associations, they used to be founded mainly in order to offer people a saving opportunity. With the credit unions, because the name already says that, it's much more about lending and giving out loans to local business owners. And they are organized as a registered cooperative company, eingetragene Genossenschaft. So if you ever see a bank that has an E and G at the end, it's a credit union. Now, German people will know this. Most of the credit unions are, the vast majority of credit unions are Volksbanken, people's banks. But there are some famous cooperative banks that you would not think at first that it's a cooperative bank. We have one central group institute, DZ Bank in Frankfurt. And this one carries out, just like DK Bank does for the public banks, it carries out central bank functions for the cooperative banks. We have, or used to have, approximately 1,000 Volks- und Raiffeisenbanken, approximately 10 Spar- und Darlehensbanken, Sparda banks, 5 PSD banks, those are pure retail banks, and some specialized credit institutions. Actually, Union Investment, Union Invest, is the asset manager for the whole sector, and R&V Insurance, R&V-Versicherung, is the insurance company within this sector. So what will happen is, if you go to Volksbank Leipzig, you can buy an insurance contract and you can also invest in securities, but those services that will be offered by the Volksbank are actually done by R&V Insurance or Union Investment. And finally, we have some banks that operate as a registered cooperative society, but which are usually not considered to be a Volksbank. Famous one, APO-Bank, actually the largest cooperative bank. APO-Bank is a bank that was founded by physicians and pharmacists because they realized that they would not get the loans from normal banks because their business is so highly specialized. If, for example, you're a radiologist and you want to open your own practice, you need to buy an X-ray machine and maybe an MRT machine, and you need 2, 3, 4 million euros initial investment. No bank will give you such a loan. Also, if you're just a general practitioner, you will have to buy the practice from the former physician. And I've heard that you have to pay, I think, 2, 3, 4 times an annual profit to the former owner of that physician, of that practice. So, for example, if a physician makes 200,000 euros and you want to take over the private practice from him or her, you have to pay 600,000 to take over the practice. This is how it works with physicians in Germany. So if it's a radiologist, you need maybe 4, 5 million euros. And you don't have any equity. So what happens is you go to APO-Bank. They've experience in this sort of things. They have physicians and pharmacists working for them, and they will know how to do a proper credit risk assessment. And you will get a loan from them. And it's a credit union. It's a large bank. Also, we have some church-owned banks. For example, the Pax Bank is the bank of the Catholic Church here in Germany, Pax Bank. Pax as in peace, the Latin word. Unfortunately, during the financial crisis, they had a scandal that they actually heavily invested in arms companies. Doesn't work so well if you have peace in your company name, but they are church-owned, and it's a credit union. So these are the 10 largest banking companies. Deutsche Bank, at least 7 years ago, Deutsche Bank, Commerzbank, KfW, DZ, UniCredit, LBBW, Norddeutsche Landesbank, and so on. Okay, number of banks. You can go through this. Business structure, German universal banks, and so on. Some background on the German banking sector. But you should know we have 3 pillars. Public banks, usually state-owned, city-owned, local banks. We have local credit unions, and we have few but large private banks. And all of them compete in the same free competitive market. So some savings and loan banks can go bankrupt, some credit unions can go bankrupt, and actually some state-owned banks have done that as well. Okay. Any questions up to this point? Then now let's turn to a more theoretical part. Actually, this is the toughest part of the whole lecture. It's basically the model for which everyone every year expects the next Nobel Prize to be awarded for. We'll talk about the diamond model. This is the theoretical model from financial economics that defined banking theory, that gave the starting point and the initial starting point for what we would now consider to be financial intermediation. Why? We do know banks exist. But for an economist, we should try to explain what are the reasons why do we have banks at all. In a theoretical setup, there have to be some reasons why banks fulfill important functions in an economy in such a way that these functions cannot be taken over by anyone else. This used to be rather strange in previous years, because you could argue, well, we have banks, we've always had banks, and why do we need to care about why we have banks? Nowadays, with companies like Apple, Google, fintechs attacking banks, and services being transferred away from banks to platforms and tech companies, this has become even more important. What are the benefits of banks in contrast to other companies? What can they do better than other companies? And we'll talk about this here in the second section on the existence and the explanation of the existence of banks. And basically, it's the diamond model from the 80s. We'll start with financial contracts. I told you when I defined a bank that in financial economics, in banking theory and financial intermediation, it's done at the most general level. We talk about financial intermediaries, financial institutions who offer financial contracts. A financial contract is just any contract that capital is transferred from A to B. It could be a loan, it could be a deposit, it could be a financial derivatives, we don't care. Capital goes from A to B, and we have financial intermediaries that now step in. So we'll start with financial contracts, and then we'll move on. Why do banks exist? We start out with a perfect capital market. No transaction costs, no information asymmetries, everyone knows everything. Depositors and investors could simply channel their savings efficiently to investment projects. We start out like this. I have capital, you don't. I give you my capital for an interest rate. I can assess your risk. I have no transaction costs, so I can simply give my capital to you. Done. Perfect capital market, no transaction costs, no information asymmetries, no financial intermediaries, no banks needed. Done. However, we have transaction costs. So it might be that banks exist because they can do it cheaper than if we were to do it directly. Banks provide certain services. So it could be that they can do something additionally, or it could be that information is not equally distributed. We don't need transaction costs, but it could be that information is unequally distributed. What information? Risk and credit default risk. I have too much capital. You are, let's argue, you are a company. You want to invest. You need capital. I cannot assess your credit risk, and I would charge the wrong interest rate. I would charge the wrong price. Very simple setting that you should know from new institutional economics. Most important example of information asymmetry. Does anyone know? Actually, that one received a Nobel Prize in economics. Yeah? Yes, the market for lemons. Used cars. If I buy a used car, I cannot fully assess the quality of the product. So what I will do is I will simply assume that, let's say we have two cars, 10,000, 5,000. I cannot assess the true price. If I want to buy it, I will simply make an average price. I will simply argue that, okay, if I pay 7,500, it will be somewhere in between. Who is willing to sell me this car? Only the ones who know that their car is only worth 5,000. If you are selling your car and you know that your car is worth 10,000, you will not sell it. So what follows is adverse selection. I will only select the bad ones. Works in insurance, works in any other market where you have information asymmetry. The result is that only the bad cars are sold, and as a result the market breaks down and we have no transaction at all. Here the same. I can only select or I cannot select the good loans from the bad loans. I will set the interest rate, the price for capital, at an average rate, and I will only systematically attract the bad ones. Companies that already know that we will default anyway, so we can accept any interest rate. We can also pay 15%. And this is what happens then. So we have an information economics approach to explain the existence of banks. Asymmetric information should be quite clear. It's present when one party of a transaction, of a contract, knows more than the other party. And we have this everywhere. In markets, in insurance, and in banking. Can you give me an example in insurance economics? It's also a famous field where you have to deal a lot with information asymmetries. Information asymmetry can take place before and after finalizing the contract. Before, it causes adverse selection. After the contract has been signed, it causes what we call moral hazard. Can you give me an example of adverse selection and moral hazard in insurance? Adverse selection, health insurance, smokers versus non-smokers. I'm an insurance company. You are my potential customers. A smoker would have to pay 1,000, a non-smoker would have to pay 500 euros per month, let's argue that, for health insurance. Now, if you are my potential customers, what can happen is I will ask you, do you smoke? You will say no. Everyone will say no. In this setting, I cannot check whether you smoke or not. So what I can do is, if I know that 50% of you smoke and 50% do not smoke, I will simply set the premium at 750 euros. Arguing that if I select one smoker and one non-smoker, on average, the fair premium would be 750. Now you know that you are a non-smoker and you should pay a fair premium of 500. If I offer you an average premium of 750, you will say, no, I don't want to buy that insurance. Maybe you're a smoker, you think, I smoke, I should have to pay 1,000, the company is offering me 750, so you will accept. What follows is, I'm an insurance company, I end up with just smokers, I calculated a fair premium of 750, I end up with customers who should all pay 1,000, I go bankrupt, no insurance. And everyone loses because there will be no health insurance coverage for anyone. What I can do is, and this is called adverse selection, I'm selecting only my adverse risk. What happens is, I can check how to lower information asymmetries. And if you apply for insurance, you will see you will have to fill out a form asking you what are your prior sicknesses, any prior illnesses, do you smoke? In health insurance, you might be asked if you engage in high-risk sports, if you do snowboarding and this sort of thing. And the insurance company will try to lower information asymmetries, decrease information asymmetries. Now what happens is, after signing the contract, it could be that you suddenly start to smoke. And this causes moral hazard. You enter a contract, even if it's a social contract, a non-legal contract, and your contract partner relies on that you stick to your behavior. But then you suddenly think, well, now I can start smoking, I can now start snowboarding, and your risk increases and you have moral hazard, meaning that you behave immorally after committing to a contract. That's moral hazard. And eliminating problems associated with asymmetric information causes costs. And we also sometimes refer to these as agency costs. Because one field where we almost always have these types of information asymmetry costs is in a principal-agent context. You have a principal, you have an agent, you have a firm owner, a shareholder, and you have a manager. And the manager doesn't always act in the best interest of a shareholder. And to reduce the information asymmetry, you have to invest. For example, you need information and monitoring costs, and these are referred to as agency costs because they are necessary to reduce agency problems and principal agent problems. Financial contracts, project evaluation, monitoring, and these are equal to the difference between the best solution at symmetric information, that's the first best solution, and asymmetric information. And later on, we'll talk about these differences. The best solution would arise in a situation where you have no information asymmetries at all. And the second best solution is the best thing you can do if you have information asymmetries. So for the insurance company, the best situation would be if you were to know who is a smoker and who isn't. The second best solution is the best solution including the lowest amount of information costs so that you can distinguish who is a smoker and who isn't. If it suffices to include this question in a form and everyone needs to fill out the form, if you're a smoker, check yes or no, then the costs of producing that form and having customers fill out that form, those are the information costs. And if these information costs are minimal, you could also try a health screening maybe, or take a blood test. That's also possible. These are different scenarios, and the scenario that gives you the lowest information cost, that's the second best. And the difference between first best and second best, those are your information costs and the costs of financial intermediation. And later on we'll see different types of financial contracts, and we'll try to find the financial contract that offers the second best solution in contrast to first best under symmetric information. Okay. Now I've used up all my time, so let's stop here. Do you have any questions? That's not the case. So thank you very much, and see you next week. Thank you.